Hi, Adrian Quick here, the module leader for our finance module on this data center master's degree. We've been putting together these bite-sized lectures because the feedback really has been that this module is quite difficult just to study from a book and so on, read it. It's new concepts for most of us, so perhaps some explanations on underpinning knowledge helps. And the other thing that I would say strongly is you are working at level 7, which requires critical evaluation. So how can you critically evaluate something which is brand new to you and you may need not have grasped the basics? So let me deliver some sort of basic knowledge here on management accounting. So this one is about management accounting. What is management accounting? Why is it different from financial accounting and so on? I would guess perhaps there's 4 areas of accounting in general terms: financial management accounting, and then financial management, and then perhaps pure finance. And they're separate areas and separate specialisms to some extent. But the 2 that we really need to know about are financial accounting and management accounting. I won't write up, but I mean, if you could imagine, this is financial, this is management. As if you've seen any of these before, my writing is not as good as it should be. But what is financial accounting? Financial accounting is preparing an income statement or a profit and loss account in old money and all the rest of it, a balance sheet or a statement of financial position in new money, cash flow statements. So those are prescribed accounting documents which shareholders are going to be using to evaluate the performance of the company. So that's financial accounting. You've got prescribed documents, in simple terms, in accordance with accounting standards that you prepare accounts with. So what's management accounting? Well, virtually anything else. And I suppose the nicest way to define it is to say, well, financial accounting records or evaluates performance. Management accounting is purely there to support decision making. So in other words, it can be anything at all. It can be a cash flow forecast, it can be some sort of investment appraisal analysis. And at the risk of confusing from right at the beginning, it can be financial accounts, because if you think about it, most companies will prepare financial accounts on a monthly basis to see how they're going. Now, these are more likely to be called management accounts. Why? Because they'll be in far more detail for internal use than ever the company would want to share with external persons, particularly competitors. So actually, financial accounts can also be management accounts. So let's not get hung up on the definitions of these things. I think it's probably good to get straight into the content of what we want to talk about. So actually this week is called cost behaviour, but it's more than just simply cost behaviour. But let's start with what we mean by cost behaviour, because we have to understand the basics before we can then see how to apply it. So let's keep life nice and easy. We accountants are simple people at heart, so we're not in the world of economics in here at all. So we'll take a factory that's producing a single item. That's all it is. Accountants in the years gone past called it, we made a widget. And this is a single item in a factory. So when we think about how might the total cost of production vary with output? How might the total cost of production vary with output? How much is it going to cost us to produce 1,000? How much to produce 10,000? So in order to answer that question, which is fundamental to management accounting, we need to understand how costs behave as volume changes. So there will be certain costs. So if this is the total here of money, and this is the volume of output, if I'll just write, if you can read this, just write output along this axis. So this is producing nothing, and this is obviously producing a lot, and so on. How much is it costing? Certain costs in a factory will be fixed. Things like the rent of the factory, the insurance of the factory, perhaps the supervision on the factory, and many others. So if you were to put a sort of a line here, your fixed cost line would look like that. So in other words, the total fixed cost is not changing as output is going up here. If you produce nothing, you still have to pay all of those fixed standing charges. So we can call this line here a fixed cost line. And then of course you've got costs that do vary with output. Each of our items of output, our widgets, requires materials. And if you think about it, if you double the output, you're probably going to double the materials. Be careful, because that's an assumption that I've just made there, but we'll come back to the level 7 stuff once we've done the basics. So a variable cost line, if you don't make any, okay, and we assume that we've got no inventories and so on, again, just creeping ahead a little bit, but if we don't make any, it doesn't cost us any. anything at all. So therefore the variable cost line, the total variable cost line, would start here. And randomly, it would increase in a linear fashion. If we double the output, we double the total variable costs. As I say, I've made an assumption there, but we'll come back to this. So that would be your variable cost line. So what we need to understand, that it is key in management accounting. And I suspect that as data center managers, we're probably going to be involved in this far more than we are with financial accounting. So I do think this is key, that we need to understand how costs vary as output varies. Now, of course, you've got to have what we call semi-variable costs, which are mixed costs in another language and so on. An element is fixed of those costs, and then there's an element of variable costs. I'm a bit old-fashioned, but in the olden days, the good old telephone, the GPO telephone in this country, used to have a monthly standing charge, and depending on how much you used the phone, you then paid for the usage on top. I think certain mobile phone contracts operate like that anyway. So if you imagine that you've got this semi-variable cost going on here, that would have a fixed cost element, and then the more of the output and so on. So you could have a line sort of like this. I'm going to get rid of this one, and you can call this a semi-variable cost line. So those are the basic ways that costs can behave. And I just get a rubber here. Fixed, variable, or then semi-variable. So it's important to know that. Right. Now then, if we think about how we apply these costs, if variable costs are varying in direct proportion with output, clearly they are going into the product. They must be. They're being used by the product. That's why they're varying with output. They're being consumed as we make the product. So sometimes you will see, and be a little bit careful here on these definitions, but sometimes you'll see these referred to as direct costs as well. Direct costs. Why? Because you can trace it directly into the product. And then these fixed costs here, sometimes, surprise, surprise, what am I going to write? They're called indirect costs. Costs that really you can't trace to the product, but you need them, of course. You need a factory to produce. So that's the basics of cost behavior in a nutshell, in however many minutes that took. We'd be a little bit naughty, because if life was so straightforward, as I always say, anyone could do it. If I then challenged you and said, what's that line? I know you come back and say, well, that's the total fixed cost line, Adrian, you said that. But of course also, if you think about it, that line there is the same as the variable cost per unit. The variable cost per unit. So if it costs 6 quid of the material to make one item, it's still going to cost 6 quid per unit to make 100 items. So actually be careful here that a line that looks like that could be a fixed cost line, but it could be the variable cost per unit. Sorry, being careless here. Okay. If that's the variable cost per unit behaviour, it doesn't change. What about the fixed cost per unit? Well, of course, if you think that we've got fixed costs, I'm just making some numbers up here, of 100 million, 1,000, or just 100, keep it simple. If we produce one item, yes, one item, then the fixed cost per unit is going to be £100. But if we produce 100 items, the fixed cost per unit, 100 over 100, is £1. So it would come down here. And in fact, we'd see that there would be a curve in this case of fixed cost per unit. So that's what the fixed cost per unit graph would look like. Okay, so maybe enough on cost behaviour, except to say we've made some assumptions. And obviously the assumptions that we've made all the way through this is that cost behaviour is linear. First of all, let's come back quickly to our fixed costs. What's the reality? Are fixed costs fixed however far I draw this? No, of course they're not, because you're going to reach the capacity of your factory or your data center or what have you, and it's going to require an investment in more space or more capacity or something like that. So in truth, there's no such thing as a fixed cost line, or you could say it's only fixed within a certain range of output. That would be the correct thing to say. And generally, fixed costs, we call those stepped fixed costs. So as you increase output, there'll come a point where you need to increase these fixed costs, get more supervision and get more factory, what have you, and so on. And we call that stepped fixed costs for very obvious reasons. So that's just a little bit of critical analysis, hint, hint, level 7 stuff on some assumptions here. And what did we say about variable costs? That they're also linear. Well, I don't know about you, but I mean, if I go into a shop and I'm going to buy 100,000 of an item, doesn't happen very often, right? I'm going to be looking for a bulk discount, aren't we? Isn't that normal in business and so on? So to say that this total variable cost line is linear is also probably an overassumption, over simplification here. So probably there's going to be a point where, above a certain purchase order, the cost per unit goes down, so therefore there'll be a break in this line perhaps at this point, and then it goes up less steeply because we're now paying less. And to make it even more complicated, you might see that actually when we reach that point, we get a rebate on all the purchases, and in fact the whole price goes down, so then you'd have a funny sort of total variable cost line, because it would dip down like that and go up at a less angle and so on. So just a couple of words on the the limitations of all of this. But as I say, we accountants need to keep it simple. Fine. And then something called the high-low method. Once again, here we are, and we have a semi-variable cost. And we're trying to identify how this cost behaves. Now, in reality, it would be nice to think that if we actually observed everything, it would be on a perfect straight line. Life is not like that. There's random elements coming in, production doesn't work possibly, or we have outages or qualities and all sorts of stuff. So if we had an observation of this cost, and this is output, so here let's call it quantity going this way, that in fact what we're likely to see is not quite a straight line, but we would see sort of this sort of random variation and so on. So if we wanted to understand how this cost behaved, we need to do a line of best fit through there. All right. Now, if we're not, we can do that. That's, I'm sure those of us are a little bit mathematical. I wouldn't call myself that, but I mean, a line of least squares regression would be the line of best fit there. But we accountants keep it simple, and in order to have the approximation, we always use the two extreme values, because obviously, if we use these two, then the line would be like that, which would be nonsense. Of course it would. So, in order to get the line of best fit, we always take the highest value and the lowest value, and you'll read about this high-low concept, that basically what we do is to work out the equation of this line as if it was joining, those 2 points there, and not worry about those random variations in between. So just a quick word on high-low. All right, so if that's cost behaviour, one key concept that you have to get to grips with in management accounting, and I'll do my best to write it so you can read it, is the concept of contribution. And what do we mean by contribution? Because contribution is not profit, not exactly profit. To define contribution, basically you take the selling price, can I abbreviate this, the selling price of an item, a single item, and let's keep it nice and simple, and let's make it 10 so the sums are easy. That's what we're going to sell this item for. Now, we've been able to divide the costs into variable costs per item and the fixed costs that we've allocated to this. Do you remember we said 100 over 1 or 100 over 100, and we found out how much fixed costs each unit had to bear. So basically, if we take the selling price and we take away the variable cost, arbitrarily the variable cost is 4 per unit, what goes into variable cost? Just quickly, labour, direct materials, any direct expenses, the cost of hiring a machine, especially to do some product or some function on that product, or where you can identify direct electricity that's gone into actually making that product. Those sorts of variable costs. So if you take that variable cost from the selling price, we can do the arithmetic, that is our contribution, accounting contribution. So in other words, that if we make one of these, we will have a positive cash flow, whatever, or I don't want to use the word profit, but we will have £6 extra money in the organisation. And again, with our linearity assumptions, if we make 100, then we'll have 600 contributions and so on per item. And this is a very important concept here, this contribution, because if you think about it, if you stop making this product, what are you going to lose? Answer, you will lose the contribution because you're not selling it, but you're not incurring those variable costs either. So basically, if you stop making this, you lose the contribution. Now, let's say in past life, I've come across situations where companies have made some poor decisions because they really haven't understood this basic idea of contribution analysis. Because let's say in this case here that can I be direct? Not CNET Trading I'm talking about, certainly not. Another organisation from my dim distant past. We were training accountants, as it happens. We were training accountants. And let's say that this was the cost of putting on, a course where we would charge whatever, £10 for the course, silly numbers obviously, the cost of the lecturers plus the hire a room, something was £4, so we were making a contribution of £6 per course. Now, when we were looking at the profit statement, in order to work out the profit on this course, perhaps I should put some thousands in, otherwise we're thinking this is complete nonsense. Fixed costs have been allocated against this of, let's say here, £10,000 was how arbitrarily the fixed costs have been allocated. So if you look at the sort of the profit statement here, we've made that much sort of, I don't like the word profit, but that much profit contribution from the difference between having people come in and paying lecturers to deliver and so on. We've allocated those fixed costs, but of course we've now got a zero here. We've got a loss on this course. And therefore it goes before the decision maker, who unfortunately hasn't had the benefit of this training, sees a loss-making course and says, right, well, there's clearly, loss-making businesses, it's not good strategy to continue with those, so what happens? Kaboom, kaboom, the course is cancelled. But you must already realise the futility of doing this, because if you cancel the course, what do? Yes, you get rid of £6,000 worth of income, but you're still left with those £10,000 of the costs, which you need to go and find somewhere else to be absorbed, somewhere else to be used up. So actually, if you do this, you've got to make very, very sure that actually you can deal with those fixed costs. Otherwise, you're fooling yourself, and actually this would be what we would politely call suboptimal decision making. And in truth, in my career, I've seen this many, many times, that where we call this absorption costing, where fixed costs are absorbed into the cost of something, it apparently gives a loss, so we'll can it. We'll carry on with this, but flipping heck, we've actually lost £6,000 worth of, well, in this case, it would be profits here in doing this. So, when we talk about short-term decision making, should we make something? Should we buy something? Should we discontinue making something? Should we make a new product? All of these sort of short-term decisions, we're always looking at contributions and making assumption about fixed costs, that fixed costs remain the same. Or if they don't, then at least we need to know by how much they change. But basically, we will sort of enter into a decision if the contribution that's generated is positive. That's the concept of short-term decision making. So the next topic, quickly, is this concept and tool that's very common here, and it's called break-even. Sometimes you see it as one word, sometimes you see it as two. You're not going to impress your friends down the pub if you pick them up on that. Break-even analysis. It's a very common tool that's used in management accounting, and basically I think also in real everyday work, I can say this is one tool that I've used on many occasions to justify a decision or to give the financial input into a decision. So what is break-even analysis? Very quickly, if we look here again at our money, our total costs, and this is our quantity. The more we produce, obviously this is zero quantity, zero cost sitting there, more quantity going this way. Break-even analysis is just simply this, that we know that we're going to produce and sell an item. And again, you can do multi-product break-even analysis, but with respect, it's beyond the level of what we need to know for this course, but you certainly can apply this to multi-product situations. But let's keep it simple with a simple product, our famous widget and so on. So we know that we're selling these, did we say for £10 an item or something like that? So here is our total sales line, how much that says total sales, how much we're going to receive in terms of income and so on if we sell a product. And then, of course, I'm not going to confuse this because it doesn't particularly help, but we could then put on a fixed cost line. We could then put on a variable cost line, which of course would be a lower slope than the sales line, because it's only, was it £4 or £6 or whatever? But I mean, that would be like that. But what we could do is to add those two lines together. Doesn't it make sense to add them together? So we'll have a total cost line, of which, of course, this is the fixed costs. That's where we start from. And then we come over here, coming up with a slope. And so this is our total cost line. And we've done all sorts of, estimates to actually get these equations and so on based on studies. So you can see, in terms of money, I hope it's blindingly obvious that where the total sales equals the total costs, we make no profit, no loss. So this is called the break-even point. So in terms of quantity, if we knew how to do these things here and got that, you could say that this is the break-even, hope you can see that, the break-even quantity here, where total costs equal the total revenue. Once again, critically evaluating this, all the assumptions have gone into this that we don't like. The assumptions that fixed costs are fixed over whatever range, the assumptions that variable costs are also fixed and we don't get bulk discounts or what have you, and the assumption that we can continue to sell our product at the same price regardless of how many, and so on. So all of those underpinning critical assumptions are part of our critical evaluation of this oversimplified technique anyway. But what it does allow us to do, and I think this is quite useful, is to say, well, look, if we're budgeting to make, I don't know, an extra 500 units over the break-even quantity, let's say this is 9,500 and we're budgeting to make 10,000. So it gives us actually, a tool to say how much profit, the difference between sales and costs, how much profit are we going to make at that level. And often what management is interested in, of course, is this gap here, or this difference here, and we call this the margin of safety. Sorry, told you my writing was not ideal. Margin of safety. So in other words, by how far, that should have been a straight line, sorry, by how far would our estimated quantity have to fall before, can I say, we're in trouble down here because we're making losses. We haven't actually produced a profit with here. So that's what we call the margin of safety. And you can express that in the number of units. You can express it as a percentage of the budget. So if this was 200 and the budget was 1,000, would that be a 20% margin of safety? 200 over 1,000. Break-even quantity, if that was 800, again, you could express it as a percentage of the break-even quantity. And so you can see various ways of doing it. Provided you tell what you're doing, that's fine. So that's just a very, very quick overview of single product break-even analysis, where you're looking at how to estimate or whatever how much profits you're going to make. And if you do this, you will find, and actually it is very useful to have this in your toolkit, that your break-even quantity, and you can prove the maths yourself, it's not maths, it's arithmetic, but the break-even quantity is defined as, or simply calculated as, the fixed costs divided by the contribution per unit. And that's a very quick way of finding out what your break-even quantity is. And as I say, it's very easy. I won't do it now, but it's very easy to show that equation is easy to derive, because if you think about it, if you take the sales, take away the variable cost, you get contribution. From the contribution, take away the fixed costs, you get the profit. Juggle it around. There, that's what it comes out with. So that's your break-even quantity expression. So I think enough on break-even. And then finally, the concept of absorption costing. And again, this is a very brief, bite-sized lecture. And you'll be pleased to know that I won't go on for 3 hours about absorption costing and methods of costing and so on. Keep it brief. We have a product. And we've identified that the variable costs, can I just keep this brief? The variable costs for this product, materials, I don't know, $2, £2 or what have you, and labour, I don't know, 3 per product, 3, we pay people a princely sum of £6 an hour and it takes half an hour, so each product is £3 worth of labour. So therefore we could say that this is our total variable costs. We've got no expenses in here. push this out here, of £5 per £5 whatever it is per unit. That's our total variable costs. And if we had the selling price up here, just to recap quickly, if our selling price was 5, do you agree that I could say contribution 10 minus the 5? There's our contribution. So each one that we make £5 worth of money in the bank, if you like. Now, if we were costing our product, we could say that our product costs us, how much does it cost to make a product? It costs us £5, and that's true. I don't think it's the whole truth, but it's not a blatant untruth. But we would call this variable cost the marginal cost. Marginal cost, the cost of making one more. So at the margin, the cost of making one more is £5 here. And applying this method is called marginal costing. So marginal costing is where we only take into account the variable costs of producing the item. But of course, this is not where the story ends. As I showed you before, we've got fixed costs in a factory, and therefore we need to somehow cover those fixed costs. I mean, if we said, well, hang on a sec, let's not know, if it costs 5, we can undercut the market and go in with a selling price of 6 here and still make a profit. Well, you make a contribution, but you might not be making enough to cover the fixed costs that should be allocated against this. So if you then take the fixed cost of this item, and this is quite arbitrary, but we've decided that each product here will take £3, then our total cost, 5 plus 3, 8, quite simple, I hope. And this is what we would call the full cost, but you also will see this as called the absorb. You absorb, it's kind of strange, it's not an English lesson, but this is absorb with a P, absorption costing, where we have absorbed the fixed costs into the product here. That £3, that $3 has been absorbed into the cost of the product, and therefore that's why we're saying this is £8. And this is what we call full costing or absorption costing, which is the normal method, I have to say, that a business will use. Now, the only words of caution here are, where did that £3 come from? Now, this is sort of part of a bigger discussion of what we would call cost allocation, and how do you allocate costs and so on. And I could say, looking back in my finance career, perhaps, how to put it, the more challenging days in my life have been to sit in judgment between two departments who were telling me that they should bear all the costs because they got more people than us, well, they use more space than us, and so on, all the rest of it. And at the end of the day, someone has to decide how we allocate these costs and what are the basis of doing this. Let me give you a really stupid example which I've used for a long time, and that is that we have a factory, and we don't, that produces paper clips, and it produces Rolls Royces. Unusual, but it's an unusual factory, but that's what it does. And it produces 1 million paper clips. So, can I just clear this? It produces 1 million paper clips. So this is clips, and it produces 100 Rolls Royces, motor cars. So do you agree that the total production here is 1,100,000 items, adding the two together? Now, just to keep the math simple for Adrian and everybody else, let's say that our annual fixed costs, sorry, I've just rubbed those out, it's careless of me. So there's your paper clips and there's your Rolls Royces. Now, our annual fixed costs just happen to be 1,100,000. Because that keeps the maths very simple. So if we were absorbing or allocating fixed costs based on purely production, it would be that each paperclip would have a £1 fixed cost element, and each Rolls Royce would have a £1 allocation of fixed costs. And if we understood, this makes very expensive paper clips and very cheap Rolls Royces. So actually allocating fixed costs is a key element now in management accounting in order to make proper decisions, because if you do that, you're not going to be selling paper clips at £3 a time or what have you. So basically what we try to do when we absorb costs is to find what we call bases of apportionment or allocation which are fair between them. So if we had a canteen which was free to people, what a nice place that would be, then between different departments we might say, well, hang on a sec, you've got 20 people, you've got 10 and you've got 5, so you take 20 whatever it is 35ths, you take 10 35ths and you take 5. So we've allocated those costs on the number of people. Okay, you're a production department and you're a finishing department, you've got 500 square meters, you've got 1,000 square meters, you take a third of the cost. That sort of allocation. And this was traditional absorption costing. Traditional absorption costing. So if you're asked to, hint, hint, sort of critically evaluate or again comment on how things have changed, you would certainly know that the variable cost element of any product has been severely reduced by technology and automation in the last 20, 25, 30 years. So fixed costs have been enormous and very important, so therefore the importance of allocating fixed costs is now critical in order to get good decision making. And how do we do that? And it's something called activity-based costing. And all activity-based costing is a method of apportioning fixed costs based on what we call cost drivers, so what causes those costs to be incurred. And we have cost pools, so we have pools of costs. And basically what we do is to split those costs out into the various cost centres, as I say, using what we fancily call, sorry, a bit messy, cost drivers. Simple as that. And that's activity-based costing. Will you ever be required to do a detailed activity-based costing? I spent 3 months of my life in a port in Finland doing a full ABC analysis on our port operations. I'll never get that time back again, and it was extremely cold in Finland. But we certainly learned about our business for sure. So activity-based costing, I'm just giving you a heads up here, is something you are bound to come across in data centers, and it's a heavy tool, but if you want to get the right answer, this is the right tool that we should use. And then I think I've perhaps got just 1 minute to say there's other methods of costing you'll come across, things like life cycle costing. Rather than just saying selling price variable cost, life cycle costing says, well, hang on a sec, in order to get that product we had to develop it, so we need to bring in the development cost of that item and so on. Well, hang on a sec, right at the end we've got to decommission the material and so on, or the production line and so on, and have it taken away, so we need to build. So in other words, what you do in life cycle costing is to look at the whole life cycle of the product and try and build in the cost of that product, and that's called life cycle in costing. And also I think another topic that's very hot nowadays, is environmental accounting and so on. But that truly would take me a long time to explain, certainly triple bottom lines and so on. You're welcome to read. Hope it's been helpful. A quick, well, not so quick run through of the basics of management accounting, but please, go further in your studies. Thank you.